You've done everything right. Dividend stocks, a couple of ETFs, a spreadsheet you actually keep up to date every Sunday night. And yet, somewhere in the back of your mind, it still feels like there's a piece of the puzzle missing. Not because you've made mistakes, but because there's one source of retirement income that most people in their 40s and 50s never even consider. Not because it's too risky, but because no one ever took the time to explain it properly. Meet Mike. He's 47 years old. He didn't start investing seriously until his late 30s, but once he did, he followed the playbook. Dividend ETFs, a handful of blue chip stocks, the works. Every Sunday evening, he opens his brokerage account, updates his spreadsheet, and checks how everything's progressing. And honestly, he should feel good about it. Just a few streets away lives Ray. Same age, same household income, almost the exact same amount invested, around $180,000. On paper, their portfolios look nearly identical, except for one investment Mike never added: real estate, not rental properties, not becoming a landlord, no midnight phone calls about broken water heaters or leaking roofs, something completely different. Fast forward 10 years, Mike's portfolio is producing about $600 a month in dividend income. Ray's is generating closer to $850. Same starting point, same market environment. The difference comes down to one asset class that many dividend investors either overlook or misunderstand: REITs. By the end of this video, you'll understand exactly why that income gap exists and, more importantly, how to find out whether your own portfolio has the same blind spot Mike's did. Here's what we're going to cover. First, what a REIT actually is, and why it's legally required to pay shareholders, not just encouraged to, but required. Second, the mistake that costs investors real money when they buy the wrong kind of REIT, because this is the one part of the video where getting it wrong can actually hurt your returns. And finally, I'll show you a simple formula you can plug your own numbers into today to see how adding a REIT allocation could affect your monthly income. So let's start with the foundation, because once this clicks, everything else starts to make a lot more sense. A REIT, short for Real Estate Investment Trust, is a company that owns income-producing real estate. We're talking about apartment buildings, warehouses, hospitals, shopping centers, data centers, cell towers, the kinds of properties that generate rent month after month. When you buy shares of a REIT, you're buying a small ownership stake in that entire portfolio. In return, you receive your share of the rental income without ever dealing with tenants, maintenance calls, or fixing a leaking roof. I like to think of it as the landlord loophole. You get many of the financial benefits of being a landlord without having to do any of the things people hate about actually being one. This is exactly where Mike and Ray took different paths. Years ago, Mike looked into real estate investing. He pictured himself answering a phone call at 2 in the morning because a furnace had stopped working or a tenant had locked themselves out. He decided that life wasn't for him. And honestly, that's a perfectly reasonable decision. The problem is, he thought that meant saying no to all real estate investing. Ray saw it differently. Instead of buying a rental property, he simply purchased shares of a few publicly traded REITs through the exact same brokerage account that already held his ETFs. No mortgages, no tenants, no property management, just another investment sitting alongside the rest of his portfolio. But here's the part almost nobody explains, and it's the real reason REITs matter if your goal is building retirement income. A normal company has complete freedom over what it does with its profits. It can reinvest the money into the business, buy back its own shares, hold cash on the balance sheet, or pay shareholders a dividend if management decides that's the best use of the money. A REIT doesn't have that flexibility. To qualify as a REIT under U.S. tax law, the company is required to distribute at least 90% of its taxable income to shareholders every single year in the form of dividends. If it doesn't, it loses its REIT status and gets taxed like a regular corporation. That's not management being generous. It's not a board of directors deciding to reward investors. It's literally part of the legal framework that allows REITs to receive their favorable tax treatment. Think of it as the 90% rule. And that one rule is the mechanical reason REITs often produce higher dividend yields than traditional dividend stocks. Most companies pay dividends because they choose to. REITs pay them because, legally, they have to. As of the latest full market data, publicly traded equity REITs, the type that actually owns real estate, have been yielding around 3.7%, although that number moves over time as prices change. So if you're watching this months from now, check the current yield instead of assuming today's number is still accurate. Compare that with a broad S&P 500 index fund, where the average dividend yield typically sits well below 2%. That difference isn't random. It's the 90% rule showing up directly in your monthly income deposits. So that's the mechanism. But understanding how REITs work still doesn't explain why so many catch-up investors, people in their 40s and 50s trying to build retirement income, never include them in the first place. And honestly, there's a reason for that. Most people have a blind spot they don't even realize exists. Let's call it the income blind spot. Most investing books, YouTube channels, and even financial advisors tend to lump real estate income and owning rental property into the same conversation. So if you've already decided you don't want to be a landlord, and if you're working full-time, raising a family, or simply don't want another job, that's completely understandable. You often end up crossing all real estate income off your list. Nobody sits you down and says, wait a second, there's another option. An option where real estate trades on the stock market just like your ETFs. An option you can buy and sell through the same brokerage account. An option that shows up on the same statement you already look at every Sunday night. That's the conversation most people never have. And here's something that might surprise you. You may already own REITs without realizing it. Many target date retirement funds, the kind commonly used in workplace 401k plans, already include a small allocation to REITs. So if your retirement savings are sitting inside one of those funds, chances are you already have some exposure. The difference is that it wasn't intentional. It was simply built into the fund. According to REIT, roughly 170 million Americans live in households that own REIT investments through retirement accounts and investment funds, and many of them have no idea they're invested in real estate at all. In other words, you're probably not starting from zero. You're starting from an investment you never consciously chose. And the goal of this video isn't to convince you to own REITs. It's to help you decide whether the amount you own is actually the amount you want to own. Because those are two very different things. Now, before you log into your brokerage account this weekend and start adding REITs, we need to talk about the biggest mistake people make. This is where investors lose real money. And I'd much rather you hear about it now than learn the lesson the expensive way. There are actually two completely different types of REITs. And confusing one for the other is probably the most common reason investors end up disappointed, or worse, lose money. The first type is called an equity REIT. That's the kind we've been talking about this entire time. These companies own physical real estate, apartment complexes, warehouses, hospitals, shopping centers, office buildings. They collect rent, generate cash flow, and distribute a large portion of that income to shareholders. The second type is a mortgage REIT, often shortened to MREIT. Despite sharing the same name, it works very differently. Mortgage REITs don't own the buildings. Instead, they own mortgages and mortgage-backed securities. To increase their returns, they also rely heavily on borrowed money, what investors call leverage. That's why you'll sometimes come across mortgage REITs advertising dividend yields of 12%, 14%, or even more, while equity REITs are sitting somewhere around that 3.7% range we talked about earlier. Same word, same acronym. Completely different investment. Let's call this the mortgage REIT trap, because those eye-catching dividend yields aren't free money. They're compensation for taking on significantly more risk. Here's why. Mortgage REITs typically borrow money at short-term interest rates and use those borrowed funds to buy longer-term mortgage assets. That strategy works well when borrowing costs stay low and financial markets remain stable. But when interest rates move quickly, or when credit markets suddenly freeze up, the entire equation can change almost overnight. Their lenders can issue what's known as a margin call. In simple terms, that means the lender demands additional cash or collateral immediately. If the REIT can't provide it, it has no choice but to start selling assets. And that's where the real problem begins. Forced selling pushes prices lower. Lower prices trigger even more margin calls, which forces even more selling. Before long, it becomes a vicious cycle that's feeding itself. This isn't just theory. We watched it happen during the market panic of March 2020. Across the mortgage REIT industry, lenders tightened collateral requirements almost overnight. One company after another was forced to raise cash as quickly as possible. One of the most dramatic examples was AG Mortgage Investment Trust. At the end of 2019, its book value stood at $17.61 per share. Just 3 months later, by the end of the first quarter of 2020, that number had fallen to $2.63 per share. That's an 85% decline in a single quarter. And importantly, it wasn't because the underlying mortgages had suddenly lost 85% of their value. Much of the damage came from forced liquidations triggered by margin calls. Now, to be clear, that was an extraordinary period, not something that happens in a typical year. but it demonstrates an important principle. When you see an unusually high dividend yield on a mortgage REIT, your first reaction shouldn't be excitement, it should be curiosity. Ask yourself one simple question. What kind of REIT is this? Because sometimes the market is paying you more for taking on much more risk. This is where Ray made a conscious decision, not a lucky one. At one point, he came across a mortgage REIT offering a dividend yield close to 13%. Instead of getting excited by the number, he asked the question you're now equipped to ask. What kind of REIT is this? Only after answering that did he look at the yield. In the end, he kept a small allocation to mortgage REITs because he liked the extra income potential. But the foundation of his real estate portfolio stayed invested in equity REITs. The companies that actually own buildings, collect rent, and aren't exposed to the same leverage-driven spiral. And that's really the takeaway here. The lesson isn't avoid REITs, it's know which REIT you're buying. Equity REITs, the landlord loophole version we've been talking about, are generally built for steady, long-term income. Mortgage REITs can absolutely have a place in a portfolio, but they behave much more like highly leveraged bond funds than traditional real estate investments. If you own them, they deserve to be sized with that risk in mind, not because the dividend yield happens to look irresistible. All right, we've covered the mechanism, we've uncovered the blind spot, and we've talked about the biggest trap to avoid. But there's one more piece that almost nobody mentions. It's a tax benefit that's been sitting in plain sight this whole time, hidden on a tax form that most investors never bother reading. Let's call it the hidden tax break. Under Section 1999A of the U.S. Tax Code, ordinary REIT dividends qualify for a 20% tax deduction before you calculate the tax owed on that income. If you receive REIT dividends, you'll find this amount reported in Box 5 of your 1099 DIV, labeled Section 1999 or dividends. And here's what makes this deduction especially interesting. Unlike many tax benefits that disappear once your income reaches a certain level, this one doesn't have an income cap. Whether you earn $50,000 a year or $1 million a year, qualified REIT dividends receive the exact same 20% deduction. There is one condition, though. In most cases, you need to have owned the REIT for more than 45 days around the dividend date to qualify. In other words, this isn't designed for people jumping in and out of REITs every few days. It's designed for long-term investors. And if you're building retirement income, that's probably exactly how you're planning to own them anyway. Here's something worth checking. If you already own a REIT fund, pull up last year's 1099 DIV and look at Box 5. If there's a number there, you've already been receiving income that the tax code treats more favorably than most people realize. And chances are, you never noticed it. Now let's put some real numbers behind all of this. I'm not here to tell you what percentage of your portfolio should go into REITs. That decision depends on your own goals and risk tolerance, but I can give you a simple formula that lets you see exactly what different allocations could mean for your monthly income. Think of it as the REIT income layer. Here's how it works. Take your total portfolio value, multiply it by the percentage you're thinking about allocating to REITs, then multiply that number by the current average REIT yield. Finally, divide the result by 12. What you get is the estimated monthly income that REIT allocation could add to your portfolio. Let's run through a few examples so you can see how the math plays out. Scenario 1. You've saved $50,000. If you allocate 15% to REITs, that's $7,500 invested in that portion of your portfolio. At a 3.7% yield, that REIT allocation would generate about $23 per month. No, it's not life-changing, but it's $23 a month your portfolio wasn't producing before. And just like every other income stream in your portfolio, those payments can be reinvested and compounded over time. Scenario 2. You've built your portfolio to $150,000, roughly where Ray started in our earlier example. The same 15% allocation means about $22,500 invested in REITs. At today's yield, that's roughly $69 per month coming from that slice of the portfolio alone. Scenario 3. Your portfolio has reached $300,000. 15% works out to $45,000 invested in REITs. At a 3.7% yield, that portion alone would generate about $139 every month. Now here's the important part. Don't focus on my numbers, run your numbers. Maybe you're comfortable with a 10% allocation, maybe 15% feels right, maybe it's 20%. Whatever percentage you're considering, plug it into the formula and see what it actually does to your income. Because once you can measure the impact, you're making a decision based on numbers, not assumptions. And if you don't feel like recalculating everything every time your portfolio grows, I've already done the heavy lifting for you. The free calculator, linked in the description, estimates your core dividend snowball using your own portfolio values. If you want something more advanced, including multiple contribution tiers, income projections, and automated tax lot tracking, the Dividend Income Toolkit was built specifically for that. It's designed to do exactly the kind of calculations we just walked through, automatically. Let's bring everything together, because we've covered a lot and it's worth making sure the big ideas stick. First, there's the landlord loophole. That's what a REIT really is. A way to earn income from real estate without buying rental properties or dealing with tenants, repairs, or midnight phone calls. Then there's the 90% rule. That's the legal requirement that forces REITs to distribute at least 90% of their taxable income to shareholders. It's the reason REIT yields are often higher than those of traditional dividend stocks. Those dividends aren't based on management's generosity, they're built into the structure. Next came the income blind spot. This is where many catch-up investors unintentionally miss an entire source of retirement income. They assume real estate investing automatically means becoming a landlord, when in reality, many of them already own REITs through target date retirement funds without even realizing it. After that, we covered the mortgage REIT trap. That's the mistake that can genuinely cost investors money. Equity REITs and mortgage REITs may share the same name, but they're completely different investments. Understanding which one you're buying is far more important than chasing the biggest dividend yield you can find. We also talked about the hidden tax break. If you own qualified REITs, a portion of those dividends may receive the Section 1999A deduction, a tax benefit that's hiding in plain sight on a form many investors never look at closely. And finally, there's the REIT income layer. That's the simple formula that lets you move beyond theory and calculate what a REIT allocation could actually contribute to your monthly income, not someone else's. The good news is, none of this means you need to overhaul your portfolio tonight. You don't need to sell everything. You don't need to chase the highest yield. You don't need to make any dramatic changes. Instead, here's your homework. Open your brokerage account. Check whether you already own any REITs. If you do, find out whether they're equity REITs or mortgage REITs. Then run the income layer formula using your own portfolio balance and see what different allocation percentages would actually look like. That's it. One small exercise. But now you'll be making that decision with a clear understanding of what you're buying and why. I'd love to hear what you find. Leave a comment below and let me know. When you checked your portfolio, your target date fund, or your 1099 DIV, did you discover you already owned REITs without realizing it? I read every single comment, and I'm always curious to see how many people uncover that surprise. And if you've already built the dividend side of your portfolio, but you're wondering whether you've chosen the most efficient funds, watch The Best ETFs to Live Off Dividends in America next. It breaks down which ETFs are designed for reliable dividend income, how they fit together, and where a REIT allocation can complement the rest of your portfolio. Before you go, remember Mike and Ray. The difference between them wasn't luck. It wasn't a higher salary. And it wasn't that Ray was willing to take more risk. He simply understood the 90% rule, recognized the difference between equity REITs and mortgage REITs, and added a real estate income layer that quietly kept working for him year after year. Mike wasn't behind. He just had a blind spot. Now you know exactly where to look for yours.